Okay, good, good. You know what? If you did read this chapter, when you read this chapter, let's just flip through the chapter. Take a look at page 158, 159. You're going to look at this and you're going to say, well, I know this stuff. And then I'm going to give you the quiz where, no, you don't. You need to really know what's in these financial statements. Really, really know it. Could you prepare one on a blank sheet of paper that looks like, Young Graham's financial statement? Right now, no. Will you be able to? Yes. Not at the end of this class. Okay? But at the end of this class, you're going to have an idea what's there and why it's where it is and what's going on. Okay? You're going to learn about what are generally accepted accounting principles here, what's required. Okay? So everything you read, just like in the first three chapters, I guess, know it. Nice thing you're going to have in both these chapters, 4 and 5, is that they give you the definitions of all those accounts again that you already know, right? Learn them again. Okay? Learn them again. Make sure you really do know them. Okay? What's going on? Okay? What's going on in these statements? And they start with the income statement first. I don't know why. It doesn't matter. By the way, do you prepare a balance sheet first or an income statement first?
Income statement.
I don't care. Does anybody prefer to do a balance sheet first? That's how I learned it, so I do that first. Do I know what the ending balance is in retained earnings when I do the balance sheet even without doing the income statement? The answer is yes, I do, because debits equal credits. Of course I know what it is. I can plug the number. If I know every number in the balance sheet except for retained earnings, can I compute retained earnings?
Yeah.
I know debits equal credits, right?
Yeah.
I know assets equal liabilities plus equity, so I already know what retained earnings is. Then I can do the equity statement if I want before I do the income statement, couldn't I? I could. Absolutely I could. You don't, but you could, right? I certainly know what ending retained earnings is. That's easy. Or you do the income statement first and take the net income and plug it into retained earnings and then do your balance sheet. I don't care. Usually you do the cash flow statement last. One, because it's easy. And two, because you take information off the balance sheet, right? And I guess something off the income statement too. What do you take off the income statement for your cash flow statement? Failure 101.
Operating expenses.
Operating expenses you put on your cash flow statement. I've never seen one.
Operating activities.
Well, cash flow from operations,
Yeah.
compute. What do you put on your cash flow statement?
Operating activities.
Yeah, operating, investing, financing, you're correct. So, come on, you put net income or net loss as the first thing on your cash flow from operations. So I pull it right off of the income statement, right? It's the only thing I take off of the income statement. You don't show expenses, you show net income, I suppose. Okay, and then what? This is just like work, isn't it? This class is going to be horrible. Yeah. They'll be far worse than me. That's why I'm so keen to students.
You show how you do
A
it.
whole bunch of accountants, right? They're real busy, trying to make a lot of money and trying to get things done. So people will only tell you what you did wrong. They'll never tell you what you did right. It's really cool. It's a waste of time to tell people what you did right. And we tell you everything you did wrong. You know why? So you can fix that. You can correct the error, and so you can quit making that error. It's called training. There was a guy from, did I tell you this one? There's a guy from the University of Washington. Washington is a really good accountant. Very, very strong. And working in Tacoma, did I tell you this one? He hired this kid. I was doing the hiring at that time, acquired permanent impulsive. So I interviewed him and I hired him, and I was thrilled. From the University of Washington, he had a real high GPA. It was like hiring one of you guys. Really was. Like one of our top folks. He comes in, he goes to work for us. He wanted to live in Tacoma and he wanted to work for a small firm, and we got it. He could have gone to anything more he wanted. Big agency. Right? So he comes in, he goes to work, and then I left the firm, went to teaching at Forest University. And so I went back to their Christmas party, invited me to their Christmas party, and he walked up to me and says, Steve, do you think I'm doing okay? Yeah. He says, do you think I'm doing okay? I said, why would you think you're doing okay? He says, nobody talks to me very much. Nobody tells me how my work is. Wow. I said, that is you can just relax. Cool. So I went and talked to the partner. I said, don't you ever tell him anything? He said, well, he never does anything wrong. His work's really, really good. So why would we talk to him? I'm not kidding. This is how we do it. We write list after list of everything you did wrong. I used to get accused of getting paid by the point, we call them points. When we take these legal pads, when you did it by hand, right? Microsoft Word. So I'd write point after point after point after point, page after page, like 100 or 200 on a big job, right? this, you did not do this, you did not do this. And you'd ask a whole bunch of questions which they had to answer. Did you consider this? Did you consider this? You don't have this in the work papers, you don't have that in the work papers on an audit, right? Just support the opinion that we're given on the audit. And it's just the way it is. So when do you get no points written for you? Either you did everything right, which is highly unlikely, or you gave up and you're moving on in your career, which means you're going to work somewhere else because you're not getting it. So if suddenly the points disappear, you know, if you're working and they're writing you 100 points every job you work on, and suddenly you have none, you really got to get the resume. Yeah, it's done. I'd actually say, for a variety of reasons, somebody not getting along with the client, it's not the client, for no reason. For a good reason, it's okay to disagree about the accounting or something. But, for no reason, mean obnoxious, doing something stupid. I've requested people not be on my job, not get anything done. Boy, that's good. The manager in the CPA firm who does the hiring decides he doesn't want to be on his jobs anymore. You better find some managers who really like your work, like that you're working. Okay? It's a competitive environment. So I'm so mean to you guys because it's kind of like that out there, right? It's competitive. There are jobs where you can relax though. You've had one, haven't you? Not too bad. Comfortable. They're mean to you even in that environment?
Which environment are you talking about?
Well, you're not making 100,000 a year. You're sitting there, right? So you're doing that. Okay. Now, if you get a job, if you get a horrible GPA, you get a really crummy job, or you don't have not a CPA yet anyway, right? You don't go to get your CPA, what happens? You make 30 instead of 50 and you can relax a little. That sucks. I don't want you to relax. I want you to make 50 when you graduate, and I want it to be 105 or 70. Okay? That's what I want to do. And if you don't want to make 100, I don't care. You can go to work for a charitable organization, you can make 30 for the rest of your life. That's a wonderful thing. It's all right. And then take full responsibility for what's going on in the organization and work your ass off for your career. Okay? It's fun. Anyway, what does that have to do with this stuff? Actually, a lot. Actually, a lot. Mostly what I want to do is get you guys motivated to do this. Okay, what do we do for financial? What do we do a financial statement for, an income statement for? On page 160, what's the usefulness? These things I think we did already. Look at 1, 2, and 3 there on page 160. What's evaluating the past performance of the company? What do we call that? Yeah, confirmatory value. Excellent. Predicting future performance is a little easier to get. Predictive value. Assess the uncertainty of achieving future cash flows. But decision usefulness, well, what is it? It's predicting the future cash flows, and to calculate present values, I need to do what? Predict how much cash, and when, and riskiness. The uncertainty of future cash flows, how much cash, when, and how uncertain, and we can calculate the value of anything. Guess what we do to predict future cash flows? Do we read a cash flow statement, or do we read an income statement? Which one can you manipulate easier, the cash flow statement or the income statement? If you follow generally accepted accounting principles,
Manipulate the income statement.
you can manipulate the income statement easier than the cash flow statement? You think so?
You can adjust depreciation and different things to
You could.
income.
You can manipulate some things on it. Estimates, right? You're talking about estimates.
Lots of estimates.
There's lots of estimates allowed through doubtful accounting.
Yeah, you can.
And there's no estimates on the cash flow statement? Well, it might be true that it's harder to change the numbers on the cash flow statement in terms of recording it after the fact. But is it easy to have more cash than less? Sure, just don't pay your bills. If you don't pay your bills, you'll have more cash than if you did. Everybody agree? Borrow a whole bunch of money, you'll have more cash. Oh. So can you manipulate cash flows easier than you can manipulate net income? The answer is yes, even though all those estimates, you're right though, there are a lot of estimates, and you can cheat on the income statement, but if you really follow generally accepted accounting principles, it's hard to manipulate your net income after the fact. That's what it is. But you can manipulate cash flows. Just don't do something, right? That cause cash outflow. And do things that cause cash inflow. And you can look like you have more cash, right? Well, you would have more cash, but it doesn't look like it. But if you're going to predict what's going to happen in the future, which is better? stocks I like is where the company's been really crummy, and I somehow magically know, I don't know where I'd be rich. I somehow magically know which company is doing really horrible is going to take off. Because you know what, the stock price is real low and you can buy them, and then they take off and you get rich, right? Wouldn't that be cool? Yeah. If only I had known when Apple was on the ropes, they weren't going bankrupt or something because their stock was real low. Nobody was buying their computers. I already mentioned this to you guys, right? If I had only known what Apple was going to do, I would have bought a whole bunch of Apple. I could have bought Microsoft, and it's a brand new company. I thought it was like the working university, the financial vice president, the very first one for Microsoft, worked there, or had gone to school there. He was working with Microsoft. Could have got in real early. I didn't have enough. Invest. Really not. Can't be really rich. Right? So, you know, how do you pick the winners? So what you want is a company that's going to take off. So what if a company's doing really, really well? Is their stock a good buy? Only if they're going to keep doing it, right? But if they're going to do a downturn, not any good. So when I'm looking at these income statements, I'm trying to predict the future cash flows. That's what we care about. That's what we use these financial statements for. Also for running a company, right? Also for determining what somebody's bonus is or what their raise is going to be, whether or not they keep their job, all those sorts of things, right? So that's right there in evaluating past performance, right? Budget compared to actual, predicting the future performance, future cash flows, and then assess the uncertainty, the risk of them, those future cash flows. Limitations, there's a whole bunch of things that aren't in the income statement because we can't measure them, right? So we can't get a faithful representation of what's going on. That's reliability, faithful representation, right? It's all the same stuff, guys. And then, so a whole bunch of things are not there. Income numbers are affected by the accounting methods employed. So you're right. The depreciation method you use, the inventory method you use, how big your estimate is of a bad debt expense. What's that? Allowance for doubtful accounts? Sure. A liability for warranty repairs in the future, right? All those things are estimates. So there's tons of estimates. There are different methods you could use, FIFO versus LIFO, right, guys? So different types of things affect it, okay? Of course. And then it involves judgment, lots of judgment. By the way, nobody is going to pay you the money you're going to make for doing something that could be computerized. Everybody thinks accounting is just applying rules. Well, rules you could write a computer program for. Certainly when cash comes in, I can write a computer program that debits cash and credits sales, debits cash and credits accounts receivable, right, guys? The hard stuff is the judgment. That's what you're going to get paid for, and that's where you're going to spend all your time. Judgment, okay? It's all judgment, right? That's what makes us a professional, using judgment, okay? All right, anyway, quality of earnings, this idea of earnings management, you were alluding to that. If I mess around with estimates, what if I have too much income this year? Too much.
Look worse next year.
There's no such thing as too much income this year, right? Well, maybe there is. Because the market only expected us to have $2 per share, earnings per share, and we're going to have $2.20. I don't need the 20. I need the 2. What could I do? Save it for next year. How could I reduce my income this year and save some for next year? This is called smoothing. I don't want my income going way up and then way down and then way up and way down. I'd like it to trend upwards, gradual, right? Just straight line going up. You like that? We can make our expenses be more than our income comes down. Debit debt expense, credit allowance for doubtful accounts. Debit depreciation expense, credit accumulated depreciation. It's easy to get your expenses. Okay, switch to accelerate from straight line. You're supposed to tell people because of consistency.
Full disclosure.
Full disclosure would require us to tell people. But you know, I'm like, well, it's not that material to change. We don't really need to disclose that. You know, there's all kinds of ways. Okay? Could I make my revenues less? Sure, just save it for later. It's a very simple journal entry, right? You debited cash and credited sales revenue because you earned it. Debit sales revenue and credit unearned revenue. It's gone. Save it for next year. Debit unearned revenue and credit revenue, and I got the sales next year instead of this year. Increase the income next year, reduce it this year. Saving for the future. Isn't that a good thing, you know, to save for the future? Well, yeah, if it's cash, right? You're setting assets aside or something might be a good idea, but not setting earnings aside. Okay, so manipulating the earnings. You can make the earnings look much better or much worse, really easily, right? very simple journal entries. Accruals and deferrals do it really nicely for us. And depreciation expense is a what? You deferred recognition of the expense because you debited building or equipment, right? And now over time, you're expensing it. That's a deferral, isn't it? Right? Equipment's a deferral of expense. Building's a deferral of expense, isn't it? You didn't expense it, right? You made it an asset. How's that any different than prepaid rent? Debiting prepaid rent? It's not. You just use it up over a longer period of time, right? That's a deferral. Okay, so you can make your deferrals bigger, you can make them smaller. You make your accruals bigger, make your accruals smaller. Debit salary expense, credit salary payable for a little more. You make less money, right? Debit prepaid salaries, credit salary expense. You make more money. Are you guys going to have the power to make those journal entries? Yes. Might you ever have the pressure from an employer? What they do is they say, I know we made more money than this. I'm not lying. They really believe it. Small companies all the time. I know we made more than this. When I was at Ulster Mushroom Farms, 23, I guess, 23 years old. And I'm the accounting manager at that point. Later became the controller and the operations manager. Anyway, remember the senior management team, 25 or something. Anyway, anyway, the president of the company right away says, okay, I know we made more money than this. He says, well, then that means we have revenues that are not recorded, right? It should be. Or we have expenses that are recorded too high. Which accounts do you think, which revenue accounts do you think are too low, and which expense accounts do you think are too high? I looked through and you identified some accounts, and I went to investigate. Now, what's the danger when you start investigating? There are thousands of transactions going to the revenue accounts. There are thousands of transactions going to the expense accounts. If you start looking at the revenue accounts and you're looking for revenues that did not get recorded, will you find some? They made a mistake. They didn't record them, right? Recorded too small a number, right? Failed to record the number at all. Got the idea? Will you find it? Sure. And can you make a journal entry debiting accounts receivable and crediting sales? Or debiting cash and crediting sales? Maybe doubtful. It's cash. You can do a bank reconciliation. You're probably debiting accounts receivable and credit sales, right? And will you have made a good journal entry? Yes. What's wrong with journal entry?
Expensive.
Well, no. There might be some cost of goods sold with, but we do that. If we found a sale, we'd also record the cost of goods sold because we know about it, right? But I only look at revenues that are not recorded. What else might there be?
You're not looking at expenses that are.
Well, let's stick with revenues just a minute. What about revenues that were recorded that should not be? Might I have some revenues that haven't been earned yet and recorded in Missouri? Yeah. And I really need to debit revenue and credit unearned revenue, say, something like that, right? But will I look for them? If I'm only looking for improvement to revenue? No. So what do you need to do? Look for both. You look at everything. Don't do a selective search. Now let's do the expenses. On the expense side, what would I do if I want net income to be more? You know, they're telling me it's more. Your boss is telling you it's more. They're running the business. They know what they're doing. It shouldn't be more. You're going to look for expenses that are recorded that should not have been, right? It should be a prepaid instead of an expense maybe or something like that. Or you've over-accrued an expense, right? So you reduce the expense, reduce the payable. And those would be correct journal entries. But what do you also have to look for, gang?
Ones that you under-recorded.
Expenses that are under-reported, where they should have recorded an expense and they have not. You need debit expense and credit the accrual, right? Or you need a debit expense and credit a prepaid. That's what you're finding out. Okay? Don't do a selective search. I've had this happen a number of times in my career, where you go out, you're doing an audit, and you're looking for payables, right? And you find a bunch of them, and they're all going one way. They're all reducing their income. What do you think? Every single journal entry you come up with makes their income less. Either reduce their revenues, right? Reduce their gains, or increase their expenses, right? Or increase their losses in transactions. Everything you find goes the same way.
That'll look better in the future.
I hope. But what might you think happened? They may have intentionally misstated their financial statements to make net income more. Maybe it's fraudulent. You don't know. So you sit down, right, with another CPA probably who's working for the company, and you're the outside CPA, or at least with their accounting folks, right? do is you wait for the person to realize that you think they might have done it on purpose. So it's me, and I've been out of school a long time, and I'm the controller of the company, and you're the new auditor coming in, and you find that, and you sit there and you watch me, and wait for me to realize that I think that you think that I have a thief. And what they'll say, if it was an accident, or at least I hope it's an accident, they're not too good an actor. You think they did this on purpose, don't you? And then I'll say, I don't know. They're all going the same way. All the blood will rush out of their face, right? And they'll say, no, I did a selective search. Oh my God, I did a selective search. I misstated my financial statements. Yeah, we're going to post all those journal entries. Oh my God, we got to go look for it. We got to find the rest of them, right? Okay, don't ever let it happen. Don't ever be sitting in that chair working at that company, right? And you went and found ways to make your income better. By the way, do people also do fraudulent ones where they just debit accounts receivable and there's no customer and credit sales? Hell yes, right? And they're just outright thieves. They're not unintentional, right? So you don't know if it's unintentional or intentional. Okay, got the idea? So this whole idea of smoothing, the whole idea of quality of earnings, what's the deal? Earnings management, right? Here's another one. What if somebody comes in and takes over the company? What do they want to have happen in future years? New owners or new managers? You know, the new CEO that just is going to just turn the world on its ear and take this loser company and make it a great company. What do they want to do? They want future years to be great. Do they care about prior ones? No. What's a really good strategy? Sunbeam is a famous one. Arthur Anderson again. Sunbeam, about the same time, right? As WorldCom and the other ones. We're pursuing this. They had this high flyer guy who would come in and he'd take over companies, right? Become the president of the company. And then they give him a whole bunch of stock, right? And then the company would just take off after that. You know, turnaround artists. You're supposed to be brilliant, right? They call it chainsaw Al. Never heard of last name. He fired a whole bunch of people. He closed plants. And then he turned the company into a winner. The only problem was he didn't really turn them into winners. What he'd do is he would expense everything he possibly could. So you take perfectly good inventory and write it down, the scrap value, and then you sell it, right, for the normal sales price the next year. How big is your cost of goods sold after you wrote it down? It's almost nothing, right? So all of a sudden they're making a whole bunch of money on the sales. They're not really making any more money. He took a bath in the year he comes in. That former management didn't know what they were doing. We had to write down the inventory. We had to write down the building. We had to write down the equipment. We had to write down everything, every asset we have. And then we increased our bad debt expense for their year, right? Huge bad debt expense, huge allowance, huge warranty reserves. Everybody got the idea? And then the next year, or the year after that, hopefully in his case, right, what would happen? His expenses are real low and his revenues are normal, and boom, he's a winner. It's called the big bath. So if somebody's taking over or there's a reorganization, there's a tendency, and there's a lot of research that shows that this really happens. People write off everything. Now, you might write off a whole bunch of stuff you think you should, right? It's judgment. Or you might write off a whole bunch so you can have what's called reserves, right? You're saving those profits for future years. And you know what? The market already punished you because your stock price has gone way down because you're losing money. So what if you lose twice as much? Stock's already taken, right? So you watch for this stuff. How many of you are going to be finance types? Think you're going to be careers in finance? Does this stuff matter to you? Oh, man. You want to be able to identify this, to be looking for it, be thinking about it. Just to ask the question, man, do you think it's really that bad? Would anybody really make their financial statement look worse than it really is? Yes, if they're smoothing. Yes, if they're doing a big bath. Absolutely. And is our mindset to think that people would intentionally make their statements look worse, or would they make them look better? Better. Yeah. So we might not even look, huh? Another one is, what if there's a divorce proceeding going on? You two are married to each other, right? You get married later? Okay. You two are married to each other, right? And now you're getting divorced. And you have a company together, right? Except she works there, you don't. You have a separate career someplace. What do you want the value of the company to be? Not for less. Are you going to split it in half, or you're going to buy it in half? What do you want it to be? Nothing. What do you want it to be? You have a fortune, but she controls the financial statements. You're in trouble. So when you come in as an auditor, what do? You If it's a divorce proceeding, they're not trying to overstate their assets. They're trying to understate them. They're not trying to overstate their income. They're trying to understate it, right? So you figure out what's going on, right? So when you're working in the company, what do you want? You could not be independent if you're working as an employee of the company. You're supposedly independent if you're an outside auditor, right? You're supposedly independent. You try to be independent. By definition, we are certified public accountants are independent, right? We're independent auditors, even though the client's paying our fees. But we're independent, okay? But if you're working for the company, there's no way you're independent. But you still want to be what? Objective. What would you do if your boss asked you to falsify financial statements? Get the hell out of there. First, tell them you know that they're asking you to falsify. What they'll probably say is, no, I didn't mean that. I just want you to make them better. I can't make them better. The year's over with. It's impossible. If they're wrong, I can correct them. I can't make them better. I can't sell more stuff. I can't reduce the expense. Let's work on next year, right? I can't make it better. I can correct, but I can't make it better. Okay? So you quit your job. That's what you do. If you have a client and they want you to sign off on a financial statement that is materially incorrect, what do? Run like hell. You have to be willing to fire your client. Arthur Anderson should have fired his clients. They did not. They ceased to exist. They didn't fire their clients. They took the risk instead. Right? Theoretically not. There's no evidence that they did. They were just stupid people. Those partners helped people commit frauds and didn't get paid for it. They rationalized it. But it was good for their careers. I'm head auditor. I'm head partner on a major client. Enron was the biggest company in the world. They weren't, but they looked like it on paper, right? So the managing partner was a young partner. He didn't want to lose that client. I think that's what happened, right? Did they get money actually paid to them? No, apparently not.
They got stuff on the side, tickets to.
Oh yeah, you get that crap all the time. You should have been in an audit class. Can you go to a football game with a client?
No.
Yes, you can. And you can use their tickets. As long as it's not an unreasonable amount of money. Can they fly you to the Super Bowl, and put you up in a suite and, buy you all kinds of stuff while you're there and spend, $50,000 on a trip for you? No. But can you go to a Cincinnati game? You're a partner here in town. Can you go to a Cincinnati game with one of your clients? That's fine. No big deal. Their tickets are yours. Doesn't matter. It's immaterially irrelevant. So you do things together. That's okay. You go all together. One or the other be paid, sure. The joke was always when I was at Arthur Anderson and later at Arthur Anderson, you'd go to lunch and the joke was always, should we pay for it now or later, the client would say. Because, if they paid for the lunch, they'd charge it into their company. And if we paid for the lunch, we'd add it to the bill for their company. I'm going to pay now or later. So, so we don't worry about that so much. But it has to be small things. At Dwyer, Crimmer & Colson, people would bring in boxes of apples and boxes of oranges and candy in a box, stuff like that at Christmas. We would, in their presence, while they were still there, pick it up, carry it out to the lobby, and set it down for all the employees and anybody else who happened to come in to take one. And we were very visible about that. At a time, you can watch with an engraving in it. Really nice. Guess what I did? I did not accept it. It was material of my wealth, not for theirs, it was material. But I want to trust the clients to their locations. Yeah, they paid for all that, of course. So, yeah, it's tough. So maintaining your independence.
This was pretty extreme.
There were some extremism.
It was pretty bad.
There was some extremism. Yeah, but that's not what they do. Not for the company that. I don't think. I think it was. I think they didn't do it. They convinced themselves they hadn't really done anything wrong. Materiality, judgment calls, all sorts of rationalization. Right? So, okay. Anyway, since earnings management's a big deal, you guys. One thing too. Right after all those frauds, it seems like they happen every 10 years or so. Uh-oh. It's been a little over 10 years. Maybe we have a rational event. Although we did have the banking fiasco, right? Where they were stealing money in the stock market, subprime loans and all that stuff. That's been more recent. But anyway, it seems to cycle. So if you watch it during your careers, I'm not kidding. Everybody gets real lax and aren't watching very hard anymore. And then a whole bunch of stuff happens. Oh, by the way, if your won't be able to have as high a stock price as you. People won't want to invest in her. They don't invest in yours will grow. So if you manipulate your statements, just smooth over them. It's a little window dressing, they call it, right? So if she's doing it, don't you have to? Otherwise, you're not going to be competitive. That's the rationalization. That's it. Everybody does it. If you knew that everybody in this room took 5 hours on the exam, could you still take 3? Boy, that takes a lot of integrity, doesn't it? What if you thought everybody sitting here except for you took 5 hours? How would you feel? Would you be dumb? No, you have integrity. How would, how do you maintain that? Well, you've got to have people around you who have integrity. We need people in the marketplace who have integrity. Are there people out there who are trying to steal? Absolutely. Do they use financial statements to steal? Absolutely. Okay? So us maintaining our integrity is really critical for the economy, guys. Our profession is kind of watching, right? That's what we're supposed to be doing. And if we quit watching, boy, are we in trouble. Do you guys know these elements to the financial statements? Like on page 163? I'm not going over revenues, expenses, gains, and losses again. You already did that. Okay? The sections on page 164. Operating section, non-operating section, income taxes, discontinued operations, extraordinary items, non-controlling interest, earnings per share. You will see all of that in quizzes and exams, I guarantee you. And they give you a nice little example of a multiple-step income statement on page 165. Know what's in there. By the way, here's the thing. You don't have to put everything on the face of the financial statements. For instance, all those selling expenses listed in there, all those administrative expenses, those could be in a supporting schedule to the financial statements. So you could just have one line that says total selling expenses and one line that says total administrative expenses, and most companies would do that, right? And so you have a much shorter looking income statement, less information on the income statement, but then you have a supporting schedule or a note to the financial statements where you'd list those accounts, perhaps. Does that make sense? So we'd say disclosure on the face of the statements or parenthetically on the statements. What that means is inside parentheses. Parenthetically, so you might show on your income statement sales net of sales returns and allowances and sales discounts, and inside parentheses it would say net of sales returns and sales discounts. On the balance sheet, you might show accounts receivable and then in parentheses less allowance for doubtful accounts. Does that make sense, guys? So you could show it in parentheses, or you could show it right on the face of the statement, or you can show it in a note to the financial statements, or you can show it in the supporting schedule, whatever works better. Okay? All those are fine for dealing with accounting principles. Now, some things have to be on the face of the statements, like gross sales or net sales. You got to have sales and total there, total expenses, net income, that sort of thing. The discontinued operations have to be there. The extraordinary items have to be there. Know what has to be on the face of the statement and what can be in supporting schedules. Got it? I'll ask lots of questions about those sorts of things. Well, I'll ask some questions about it at least. Okay, so this is what a multi-step or long form looks like. Everybody see it? This would be for what kind of a firm, by the way, seeing as they have sales and cost of goods sold, both.
Merchandise.
Yeah, they're selling merchandise. They could be a manufacturer, right? Or they could be a retail or wholesaler or retailer, right, where they're buying inventory and reselling. If it's a service organization, they wouldn't have cost of goods sold. Okay? So these guys are selling product.
I thought you were asking what companies. Never mind. I got it.
All right. Okay, good. All right. And then notice, you guys do know the difference between revenue and gains and losses, right? And other revenue. Look at that other revenues and gains down there. They didn't put a gain in, but they have dividend revenue, rent revenue. What would we say about those? Those are non-operating. They are what?
Gains and losses.
Those are revenue items, but they're non-operating revenues, right? Non-operating, which are peripheral, right? In the ordinary course of business, what is our main purpose, right, would be sales and cost of goods sold. Everybody agree? Remember that? Okay, we talked about that. Okay, and so under other revenues and gains, you could have dividend revenue, interest revenue, rent revenue, right? But you could also have gains on selling non-current assets, right? Fixed assets, selling buildings, selling equipment, selling land. Could go down in there, couldn't they, guys? Okay. We could also have losses down there under the expenses and losses. They don't show one either. They have interest down there, which is fine. That's an expense that they don't want up under operations. Okay. Got the idea? I don't really think that, well, interest on bonds and notes, interest expense, well, I don't know, even then, I think that might be an operating expense for me. A lot of companies put it down below. Oh, you mean some companies could put it down in non-operating and some could put it up in operations? Yes. Okay, so you got to be careful when you're reading financial statements, that's all. Okay, so neither one's really all that preferred. But we could have losses down there too, right? By the way, can there be gains and losses on refinancing your debt? The answer is yes. Where would you put those? They're peripheral too, right? They go down below. Okay, guys? So all the gains and losses. What's the difference between a gain and a revenue?
The revenues constitutes like the major ongoing operations.
Major ongoing operations, and it's the gross revenue, right? You don't take your cost out.
Peripheral.
And gains is peripheral, and it's just the net effect, right? You don't record revenues and expenses. It's just the net effect, gain or loss. Right, guys? Same as the difference between losses and expenses, right? You guys already knew this stuff, so we're just building on it. Yeah, I told you not to forget that stuff, didn't I? All right, and so they give you an idea there. And then there's a short form over on page 167, okay? On page 167, we've got an income statement. It's a simple condensed income statement, that's fine. That is for a manufacturing organization, but they show one for, there we go, on page 168. They show the single step. So here's the single step. So the other one was a condensed one. Single step, all the revenues are together, revenues and gains, I suppose, and then all the expenses are together, got the idea, and we get net income. So this would be more for a service organization, perhaps. Okay? Boy, so it is. What do we use? The current operating performance approach on page 168, or the modified all-inclusive concept. It's pretty easy. They highlight everything that's really critical where you're having a difference to get. What's that? So what do we do? What do we adopt? More of an all-inclusive approach, right? At the top of page 169. The accounting profession has adopted a modified all-inclusive approach. When you're reading this, pay attention to this. What does it mean? We show income from operations, and then we have the non-operating items, right? Okay, the unusual, and then we have what? The unusual and infrequent things, which we call what? Both unusual and infrequent. Remember this from principles? What do we call that? It's an extraordinary item, you bet. And so when you look at that list of 4 on page 169, where do the unusual gains and losses go? Number 1, where do the unusual gains and losses go on the income statement? Where do you put them? That's the non-operating stuff. Before income from taxes, before tax expense, right guys? And before net income. Where does discontinued operations go? I've discontinued a major segment of my business. Where does that go? No, that goes after net income and is shown net of tax. Oh, so draw a line under 1 there. 1, the stuff above, right? All my revenues and expenses, right? And all my gains and losses, everything is up above net income. Then right? Everything is above income before tax. I get my net income before tax, show my tax expense, and then what? I have my net income before extraordinary items, before discontinued operations, and before not controlling interest. So flip over. Let's find the one where they show a whole bunch of stuff. On page 178, for instance, okay? Take a look at that income statement, all that stuff in red down there. Don't you have the light? You just come and hang out with us? Nice to see you. Okay, we got revenues less expenses, and we work our way down to income from operations. You see that? And then we have the other revenues and gains and the other expenses and losses. Those are the non-operating stuff. See the income from continuing operations before tax? So we have income from operations, then we have income from continuing operations. Unfortunate that it's almost the same, huh? But income from continuing operations includes the non-operating stuff. Got it? Then we show income tax, and we got income from continuing operations, then look down below. Discontinued operations, if you have them, extraordinary items, if you have them, and they're all shown net of tax. So we'll pick up there next time. One thing to note though, look at all the items that we show earnings per share on. It's from the line down. What do I mean by the line?
Bottom line. Yeah.
In from continuing operations on down, every one after that. So the first one that they are showing red there, income from continuing operations before income tax of 460, right? We divide our shares of stock into that to get our earnings per share, and then every line after that, we show earnings per share. See you guys. Keep working, keep working, keep working. I'll see if I get that thing graded for you next time. It's conceivable, I guess. Well, why are you here? Do you want to talk to these guys?
No, I don't have to.
Oh, all right. Oh, the one I haven't got done. When are the recommendation letters due?
For the KYCPA?
KYCPA is the 9th of February. The day is the 4th or something.
Second.
Good for him. But he said you're worthless. I can say you're only sort of.
You like the theory?